Hey everyone, today we're going to talk about some common moving average settings. Now, more often than not, if you bring up a chart of the S&P 500, a particular stock, you're going to see a couple moving averages on the price series. And more often than not, it's the 50-day and the 200-day. Today we'll talk about why those are the common moving average settings people use, how you can use them very simply to identify trends and most importantly, anticipate trend reversals. Let's look at the chart here. We're looking at Intel over the last 2 years, and I have the price as a daily open, high, low, close bar, and then we have the 50-day moving average in blue, the 200-day moving average in red. Now, when you're looking at the price versus moving averages, there are a couple things that you can look at. I think of it this way. First off, where is the price relative to the moving averages? In general, you want to own things where the price is above the moving averages. You want to not own things that are below the moving averages, and that's an oversimplification in some ways, but it holds water pretty well because what you're doing is you're basically following trends. You're owning things that are showing strong trend profiles, and you're not owning things. You're underweighting things that are showing weaker trend profiles. So step one, look at where the price is relative to the key moving averages, because on the chart of Intel, you can see more often than not, when the price approaches the 200-day moving average, it usually finds support or resistance. Support if it tests it from above, resistance if it tests it from below. We can also look at the slope or the movement in the moving averages. If the price is below two downward sloping moving averages, that's a chart in a pretty good downtrend. So you can see Intel here in mid-2022, price going lower, 50-day moving average sloping downwards, 200-day moving average sloping downwards as well. Now, why do we use the 50-day and the 200-day? Quite simply, they are the default settings on most charting platforms. And a lot of people have tried to speculate as to why that's the case. I think early on, it was sort of an estimate of about a quarter and about a year, right? A quarter is about 63 days, to be honest with you. So 50 is a rounded down version of that. 200 is a pretty long period. It's closer to a year, which is usually around 250 to 260 days usually. So in general, it's about a quarter to about a year, a little less than that. But remember, when these indicators were designed, it was all done with pencil and paper. So 50 days and 200 days, much more easy to calculate by hand or with a simple calculator, and that's why people went with those settings. Now, here in the 2020s, it's because that's a default setting and that's what most people are used to. So the average investor, if they've never used a chart before, they bring up a chart and it has the 50 and 200-day moving averages. That's why people start with. So I think it's valuable in following those moving averages because you know that's what so many other investors are following. Having said that, you can create whatever moving averages you want. And on StockCharts, if you go below the chart, you can actually customize all of the settings. And not just simple moving averages, you can do exponential moving averages, other more exotic settings. So things like the 20-day EMA or exponential moving average can be used. The 100-day or the 400-day moving average can certainly be used. It's most important to follow the charts and ETFs that you are interested in and see which moving average settings help you best understand those trends.